Good morning. This is live daily market outlook from Windsor Brokers for Wednesday, 11th of July 2012. More negative sentiment seen in the markets as euro fell yesterday to marginally fresh low at 122.35, keeping the focus firmly at the downside as more negative and dissonant tones actually coming from the eurozone. The comments from a Finnish Prime Minister saying that the euro is in most dangerous situation in more than 2 years was fueling further fears of the investors about the future of the eurozone. The Finnish Prime Minister added that the last time the eurozone situation was so critical was in May 2012 when Greece was near collapse for the first time. But he said it was very difficult to imagine what kind of chaos there would be if the euro area were to collapse. Finland is one of basically few remaining eurozone members to retain AAA credit rating, conscious of public opinion at home. Helsinki has been wary of taking on more liabilities regarding weaker eurozone states. It is in talks with Spain and on collateral against participation in the currency bloc's planned aid for Spanish banks. The Eurozone ministers agreed yesterday to make 30 billion euros available for Spanish banks by the end of July if struggling lenders urgently need funds. Just a reminder that Spanish 10-year bond yields dropped yesterday to 6.95%. Giving some slight optimism in the current situation. Also from the Europe, Italy seems to be eyeing Eurozone aid to ease their current debt pain. They said yesterday it may want to tap Eurozone aid to ease its borrowing cost as finance ministers struggle to convince market they are getting a grip on the bloc's debt crisis, which a top European central banker said could escalate. The Prime Minister Monti, who is under intense market pressure to shape up his economy and avoid being drawn into center of the debt crisis, said Italy could be interested in tapping the Eurozone Rescue Fund for bond support. From China, further signals of slowing down the economy basically is hammering corporate profits and costing some of the top CEOs to lose their jobs as investors show little patience for companies that fall behind, even for a brand founded by a former Olympic star gymnast and revered sport hero. In the space of weeks, at least half of a dozen Chinese companies ranging from a steel maker to the country's biggest airline warned that earnings will be softer than expected as world's second biggest economy grows at the weakest pace in the past 3 years. Still to come, it's China's GDP during this week that would likely be again showing a further slowing down in the economy. That will also affect, of course, the rest of the world. From the energies, the oil has recovered some ground after dipping to the levels at 83.60 zone, falling more than 2% yesterday after Norway ended its oil strike and basically averting a total production shutdown. And China also cuts its oil imports in June. That reinforces fears of a global economic slowdown that will directly hurt the fuel demand. For now, the oil is holding close to 85 level, with some ground being found yesterday, but overall it's still in the overall structure is still a bit fragile despite the recent strong rally from 77.27 that regained some important levels above 87. Still could be the current situation in the world economies, especially highlighting the China that is slowing down, that might signal a further reduction in the oil demand and push the prices lower. More of this we'll be seeing in our technical part. Just a brief comment about gold, that is in slight recovery mode of yesterday's 1564 low, but generally the short-term outlook is still quite bleak, as the yellow metal fell from its recent top after regaining 1600 level, but failing to regain the more important 1633, 1640, dipping down to the levels at 1564 and risking again a possible further weakness. From today's calendar, German CPI came as expected at 0.1%, with still to come the trade balance for Canada and the States due at 12:30. Canadian is expected to stay unchanged at around 380 million Canadian dollars trading up, while U.S. trade gap is expected to slightly narrow. Today's forecast is minus 48.4 billion US dollars compared to the April's gap of 50.06 billion US dollars. The U.S. wholesale inventories and wholesale sales that are due at 1400 GMT release for May are expected, the inventories to go up by 0.3% compared to 0.6% of the April's release, while some stronger decreases seen in wholesale sales with only 0.3% forecasted for today compared to 1.1% of the release in April. And finally, the U.S. Crude oil inventories that are due at 1430 are forecasted again to show the draw in the U.S. crude stocks. Today's forecast is draw of 1.1 million barrels compared to last week's dip of draw of 4.3 million barrels. Quick look now at the markets and the latest movements in the major currencies and commodities. As said, the euro is at the back foot with yesterday's upside rejection at 123.33, failing to regain first strong barrier at 123.63, resulting in a fresh slide that lost 123.00 and 122.55 last Monday's low, dipping so far to marginally fresh 2 years low at 122.35. A negative tone, negative sentiment still sees upside favored, and targets remain at 122.00 as round figure support and 121.50 June 2010 low. However, some corrective action and not ruled out. Some improvement is seen, a brief improvement in the hourly chart, but regain of minimum 123.33.60 is required to ease the current bear pressure and allow for some stronger corrective action, as descending 20 days exponential moving average currently at 123.11 maintains the current down move of the lower top at 126.91 posted on 29th of June 2012. Not much to expect from the corrective action as long as 124 as a breakpoint holds the upside. There we have the 38.2% retracement, previous low of 28th of June, as well as descending 55 days moving average, and basically lift above 124.00 would provide short-term relief and prevent the pair from the further slide. The cable is still in a sort of near-term positive tone of 154.60 last Friday's low, as this morning fresh action higher manages to crack again 155 50-hour initial support. 155.50, 155.60 is basically the our strong barrier, and the break of this level is required to signal stronger corrective action of 154.60, as yesterday's failure at 155.47 and the subsequent dip to the levels below 155, dipping to 154.77, where the bull trend line contained. The dips proved to be not that harmful for the pair, as it quickly regained the 155 level, and this morning's action is showing that there is still strength for a further extension higher, as the hourly studies are waking up of their neutral mode and started to pointing higher. 155.60 immediate barrier ahead of 155.70, 156 zone, basically break above 156, 156.20, where 61.8% retracement would be more supportive and will allow for a stronger recovery, and also will confirm the base at 154.60, 70 zone, holding the downside. This is the base lasting from mid-June, where the current range has been supported, but as upside being capped by 200 days moving average. The pair is basically still, as we can see on the daily chart, is still entrenched within 154.60 and 157.50 range. Significant was today's break above descending bear trend line of 163.00. That might be another positive signal for further extension higher. Clearance of daily 20 days moving average at 156.00 is required to confirm and improve the current still negative outlook on the daily chart. The dollar yen has basically lost ground after upside ejection at 80.00, and the loss of range midpoints at 79.60-40 zone, dipping so far to 79.20, just ahead of 79.12, 79.00, the recent range floor. Risk of a break of which would see risk of further extension lower, as mentioned in the few previous sessions. The break of either side of the range is to define the short-term direction for the pair, as upside several attempts through 80.00 breakpoint failed. Now the focus turns towards the downside, weakening hourly and the 4-hour chart studies see more focus towards the downside, and the main risk is seen on loss of 79.00, where is also the 200 days moving average currently at 78.97. That will signal an extension of the short-term downtrend from 80.61 peak of 25th of June, and open levels at the downside 78.60, 78.00 and 77.65 as a key short-term support low 1st of June 2012, and basically will signal an end of the corrective action from 77.65 to 80.61 as the pair approaches 50% retracement at 79.13. That also marks the previous low of 29th of June 2012. As said, more focus seen towards the downside on the dollar yen near-term outlook. The upside limits are reinforced by crossover of 20 over 55 days exponential moving average, and the only break above 79.50-60 would signal would prevent the pair of further sliding, and the signal return to the midpoints of the recent range. And finally, Swiss franc has managed to break above 98.00, posting marginally fresh high at 98.13, but the pair seems to be struggling at this point as hourly studies started to weaken again, and see not much potential towards the upside at this moment. Also, the 4-hour chart indicators are sharply losing momentum. Seeing again risk as the pair slides below 98.00 handle, seeing risk of retesting the near-term base at 97.40 zone, reinforced by ascending 20 days exponential moving average at 97.50 at the moment. Loss of which would be signal that the upside in the near term remains well protected, and further correction and retracement of the rally from 94.61 to 98.13 would be the likely near-term scenario. Immediate support is set at 97.40.30, where is also 23.6% retracement, with the main risk seen on a loss of 97.60.70 zone. Previous peak 38.2% retracement and ascending 55 days moving average that will sideline the short-term bulls and allow for a deeper reversal on the upside. A break above 98.00, clear break above 98.00 is to open 99.00 as next target and the psychological barrier. Our daily studies are more positive at this point, but still needs to see some stronger movements as loss of momentum in past couple of days might be a signal of a deeper reversal as stochastics are attempting to reverse from the overbought zone. As said in the introduction, the oil is in near-term descent of 88.97 peak of 5th of July that exceeded the previous low at 84.01 and dipped so far to 83.64, keeping the near-term structure in the negative mode and looking for a possible further extension lower as 4-hour indicators are breaking below their midlines and the price cracked the 55 days exponential moving average that currently moves sideways. Regain of 86 and 86.50 zone is required to avert immediate downside risk and possibly open way for a further extension higher and a possible retest of 87.00 as previous strong barrier and the recent peak at 88.97. Otherwise, risk would be seen. Any failure under 86 would be seen. Would see risk of a lower top and further extension lower, with loss of yesterday's low at 83.64 to focus 83.12, 50% retracement and 82.00 previous low of 2nd of July ahead of 81.74, 61.8% retracement. Daily studies are showing more improvement as strong momentum has been regained and the MACD is approaching its midline. It's important to see the base, confirm the base at this zone with between 82 and 83.60 that was yesterday's low in order to build up a base for further extension and further recovery of recent double bottom at 77.54 and 77.27. Otherwise, loss of 82.00 and 81.70 supports would see risk of further extension lower as fundamentals remain quite negative. Recall day of our first part of the session when I said that quite negative tones are coming from China regarding their economic slowdown that might directly affect the energy prices as China is the second world consumer of the crude oil. And finally look at gold that is in a brief recovery but still a negative tone continues to dominate off its recent peak at 16.24 posted on 5th of July 2012. Some improvement, basically no improvement. The hourly study started to point higher, but still holding in the red territory. And despite regaining initial resistance at 1576, still need to see break above 1583, 55 days exponential moving average, and 1582, yesterday's low, with the descending trend line at 1594 and 1600. Level seen a peak of yesterday, as well as psychological resistance required to avert immediate downside risk. Break above 1600 to possibly refocus again 1624. 4-hour structure is still negative as upside stays firmly capped at 1585 and 1590 and 1600. Two dynamic and one static barrier, and as said, only break above 1600 would provide near-term relief. Otherwise, extension Any failure below 1600 would be signal of lower top and extension of the short-term downtrend from 1624. That will focus immediately 1550 and the critical support at 1530, 1520 zone. That was all for today. Thank you for being with us. We're back again tomorrow at the same time at 7:00 GMT. Just to remind you, questions and answers session will follow shortly, so stay tuned with us. Until tomorrow, I wish you a nice day and a very successful trading. Good luck.